come on in. Make yourself at home, grab a snack, a drink, whatever you want. Oh, what? You don't eat? You don't drink either? Dollar Tree has agreed to sell Family Dollar to private equity firms for approximately $1 billion. This sale comes after Dollar Tree's decade-long effort to integrate Family Dollar, which it acquired for $8.5 billion. Family Dollar has struggled with supply chain issues, poorly located stores, and strong competition. So Dollar Tree finally decided to cut ties with its problem child, Family Dollar. It's like that awkward family reunion where everyone pretends to get along, but deep down, they know they're counting down the minutes until they can leave. We've all been there. It turns out supply chain hiccups and less than ideal store locations are a real buzzkill for those dollar bargain hunters. With two private equity firms stepping in, let's see if they can turn this discount disaster into a treasure trove, or if it'll just become another cautionary tale in retail history. Good luck to them. They'll need it. Microsoft is reducing its data center expansion by canceling leases and pausing construction in the US and Europe, potentially due to a shift away from supporting incremental OpenAI training workloads and a possible data center oversupply. Despite this slowdown, Microsoft plans to invest approximately $80 billion in AI data centers and affirms its commitment to strong growth. Competitors like Meta and Google are taking over those canceled leases. Those poor data centers will never get to know what a gigawatt of power tastes like. Microsoft's having a bit of a, whoops, maybe we overordered moment with their data centers. While everyone else is still scrambling for AI infrastructure, Microsoft's playing it cool, like they've already seen the future and it involves slightly less server farms, or possibly an alternative solution on increasing efficiencies. Affordable housing developers are concerned about the current administration's spending cuts, which are already impacting their work. Actions like targeting funding sources, allowing programs to run out of cash, and cutting staff are pressurizing companies and organizations addressing the housing crisis. Industry leaders fear these cuts will leave builders without sufficient funds to create needed affordable housing units. The uncertainty surrounding the funding and policy changes is slowing down affordable housing development, even as administration focuses on cutting regulations and utilizing federal land to address the shortage. Have you ever tried to build a sandcastle during high tide, but then halfway through the lifeguard comes over and takes your shovels and buckets? The government's basically saying, good luck with those housing shortages, you're on your own. They're cutting funds, pausing programs, and basically leaving developers to stare blankly at blueprints, wondering if they could somehow accept payments from good vibes and positive thoughts. I mean, sure. Let's cut regulations and use federal land. But without any money, it's like giving someone a plot of dirt and a pat on the back, expecting them to conjure up a fully furnished apartment building. The administration's focus on deregulation and utilizing federal land, while potentially helpful, seems like a band-aid on a gaping wound if the financial resources aren't there to actually build it. Demand for logistics space in the US is projected to increase by up to 350 million square feet by 2030. This is driven by factors like e-commerce growth, supply chain diversification, and the onshoring of manufacturing. This growth is expected to create significant opportunities for developers and investors in the real estate industrial sector. The demand is based on a projected 1.5 annual growth in retail sales and industrial production, and the increased need for storage and distribution facilities to support those activities. E-commerce growth, supply chain diversification. Sounds fancy, but let's be real. It's just more places to store all the stuff we bought on impulse at 2 a.m. I'm supposed to get this really cool hot sauce on next day delivery. This isn't just about more warehouses. It reflects the continued rise of e-commerce and the increasing complexity of supply chains and the need for faster, more efficient delivery networks. I can just picture it now. Endless rows of giant boxes manned by those Boston Dynamic robots doing backflips. The General Services Administration has released a new list of 8 properties across 7 states totaling just over 2 million square feet for accelerated disposition. These properties were previously announced for disposition during the Biden administration, but this initiative aims to expedite the sale of these federal assets. This action is part of a broader effort by the federal government spanning over a decade to reduce its real estate holdings. So the GSA is finally getting around to that spring cleaning they've been putting off for, well, decades. They're offloading 8 properties, which basically means they're admitting, yeah, we probably don't need these extra offices. This move signals a potential shift in federal real estate strategy, indicating a willingness to streamline holdings and potentially open up prime locations for repurposing or redevelopment. Honestly, I'm just hoping somebody finds a lost Ark of the Covenant in one of those property basements. That would really spice things up. The multifamily market is forecast to stabilize in 2025 with 300,000 net absorbed units continuing above historical averages. By comparison, 2024 saw a surge to 480,000 units due to home ownership challenges. Despite a projected slight decrease, strong multifamily demand is expected to continue offering opportunities for developers and investors, especially in markets with affordability issues. The projected stabilization stabilization of the multifamily market signals a persistent demand for rental housing, presenting a strategic opportunity to optimize portfolios and development pipelines. The 2024 surge underscores the importance of focusing on markets with strong demographic trends and limited single-family housing options. Looking ahead, while a slight deceleration is anticipated, the sustained demand suggests a need to prioritize projects that address affordability concerns and cater the evolving needs of renters. Lumber prices are experiencing a sharp increase, reaching levels unseen since the pandemic, driven by a confluence of side supply pressures. Canadian lumber, a primary source for the U.S., is facing reduced availability due to wildfires, logging limitations, and mill closures. Compounding this, the potential for doubled tariffs on Canadian imports is creating market volatility and prompting preemptive buying. The surge is reflected in significant price hikes impacting the construction industry. Industry experts are advocating for strategic interventions, including a long-term trade agreement with Canada, increased domestic production, and diversification of lumber sourcing and ensure a stable supply. If lumber prices were a dance move, they'd be the cha-cha. Cha-cha-cha-cha. I don't know if that was actually the cha-cha. Between Canadian wildfires and the tariff tango, we're all paying a premium to build anything out of wood. Now, everyone's just scrambling, and the home builders are basically begging for a lumber peace treaty with Canada. Guess we'll all be living in either straw or brick houses until they figure it out. Multifamily permits in February fell by 4.3% from January and are down nearly 16% year over year, reaching a seasonally adjusted annual rate of 404,000 units. Despite this decline, multifamily starts climbed 12.1% month over month to 370,000 units, although still 6.6% below last February. This rebound in starts suggests that the market may be nearing a bottom. While permits saw a sharp decline in the Northeast and West, the Midwest and South experienced increases. February's numbers are throwing us a curveball. Permits are nosediving, especially up north and out west, which basically screams, hold up, let's not get ahead of ourselves. But then starts are like, nah, we're good, let's build anyways. The reported stabilization of starts, while seemingly positive, might reflect a temporary push to complete projects already in the pipeline before conditions worsen. It could also indicate that developers are prioritizing existing commitments over initiating new ones. However, it doesn't necessarily indicate a healthy market. The retail industry has rebounded 5 years after the pandemic shutdowns, but consumer habits have shifted, prioritizing experiences and value-driven pricing. Work from home trends have altered shopping patterns, and while retailers have adapted, shoppers expect value, especially amid current concerns of inflation. In addition, economic instability has caused consumer sentiment to significantly drop in 2025. Retailers are focusing on experience-driven strategies and refining pricing to meet consumer demand. This isn't new news, but the pandemic accelerated the shift towards e-commerce and highlighted the need for omni-channel strategies. Retailers can't simply rely on brick and mortar stores. They need to create seamless and engaging online experiences that cater to the evolving needs of the customers. Consumers aren't going out to buy products anymore. They're investing in moments and memories. U.S. multifamily firms may benefit from the trade war as tariffs could negatively impact developers and tenants, but benefit the owners of the current properties. The multifamily real estate market is absorbing a record level of new units, and optimism is growing on Wall Street. Multifamily valuations have been squeezed as operating costs rose faster than rents, but investors can now purchase recently built apartment buildings for less than the cost to build today. It turns out, trade wars might be actually a weird win for apartment landlords. Who knew? It's like the real estate version of when life gives you lemons, raise the rent, or something like that. It's a classic case of supply and demand playing out in the most dramatic way possible. And that's it for the real estate news this week. Make sure to like this video and get subscribed for the weekly brief. And if you're looking for something to do this weekend, come and check out my Family Dollar themed party. We'll all be doing the cha-cha. It's gonna be great. No need to bring anything, just yourself.